March 2026 has seen a dramatic escalation in the Middle East conflict, sending shockwaves through the global economy and the Indian real estate sector. With over 80% of India's crude oil imported, any disruption in the Gulf directly impacts our economic stability and growth projections. The threat to close the Strait of Hormuz is a critical concern, as half of India's energy imports flow through this vital choke point. Brent crude prices have already surged, pushing India's import bill higher and creating immediate inflationary pressure across the domestic market. This energy spike translates directly to higher fuel costs, leading to a broader inflationary ripple that affects every sector of the Indian economy. For real estate, the impact is felt in the soaring prices of construction materials. Steel, cement, and paints are all becoming significantly more expensive. Supply chain disruptions and increased shipping costs are further squeezing developers' margins as they struggle to maintain project timelines. The RBI is now in a tough spot. Persistent inflation risks mean the anticipated interest rate cuts for 2026 are likely to be delayed. Instead of relief, the market must now brace for a higher-for-longer interest rate environment to keep inflation under control. For home buyers, this means elevated home loan EMIs, directly impacting affordability, particularly in the mid-segment housing category. The mid-segment, which is highly sensitive to borrowing costs, may see a temporary cooling as buyers adopt a wait-and-watch approach. Meanwhile, the conflict is significantly shifting sentiment among non-resident Indians, especially those living and working in the Gulf region. NRIs in the UAE, Qatar, and Kuwait are becoming cautious, with many pausing major property deals in Dubai to reassess their global exposure. In times of regional volatility, Indian real estate is once again emerging as a safe haven for NRI capital looking for a stable long-term bet. We are seeing a repositioning of capital as long-term investors seek to hedge against geopolitical risks by investing back home. The luxury segment remains resilient, driven by high NRI demand and a limited supply of ready-to-move-in premium assets. While the underlying fundamentals remain strong, the current conflict introduces a new layer of uncertainty that both developers and buyers must navigate. In Mumbai, the market is witnessing a unique shift. A surge in new housing launches is meeting a more cautious buyer sentiment, leading to price stabilization. Some analysts even predict a potential price war among developers in Mumbai as they compete to maintain sales volumes in a softening market. Contrast this with Gurgaon, where the market remains robust. Increased transparency and a limited supply of luxury projects continue to drive price appreciation. The implementation of RERA has acted as a critical anchor, maintaining buyer trust even amidst these global geopolitical shockwaves. While the luxury segment is shielded by affluent NRIs, the mid-segment remains highly sensitive to interest rate hikes and reduced affordability. Indian developers are now facing a significant margin squeeze as they absorb the rising costs of raw materials to keep their projects viable. Potential supply chain disruptions from the Gulf could lead to project delays, further complicating the outlook for developers and home buyers alike. We must also watch the impact on remittances. Job insecurity in the Gulf could lead to a temporary dip in capital flowing into the various Indian markets. The conflict's duration will determine how deep the economic slowdown in the Gulf goes, directly impacting the volume of Indian real estate investment. Despite short-term volatility, long-term NRI capital is expected to continue its repositioning toward India's more stable domestic market. Investors are now adopting a more strategic wait-and-watch approach, waiting for the right entry point in premium Indian hubs. Experienced and liquid investors often view such geopolitical slowdowns as a unique opportunity to acquire high-value assets at a stable price. Understanding these complex macroeconomic headwinds is the first step in making informed investment decisions during this volatile period. In summary, while energy inflation and high interest rates present challenges, India's luxury hubs remain a resilient safe haven for global NRI capital. Now we'll dive into the rupee's volatility, the equity versus real estate battle, and the future of commercial leasing in India. Let's deep dive into the 2026 Middle East conflict and its impact on the Indian real estate landscape. The Indian rupee has faced significant depreciation, reaching near 91.75 per dollar as global investors seek the safety of the greenback. A weaker rupee combined with surging oil prices is ballooning India's import bill and widening our current account deficit. For our NRI investors, this currency dip effectively makes Indian real estate cheaper in dollar terms, offsetting some price appreciation. The equity markets haven't been spared either. March 2nd saw the Sensex record its steepest intraday drop in months, tanking over 2,700 points. The Nifty followed suit, tumbling 2% as fears of supply disruptions through the Strait of Hormuz spooked global institutional investors. Market volatility, as measured by the India VIX, has surged to its highest levels since 2025, reflecting widespread investor anxiety. In times of such extreme equity volatility, many domestic investors are pivoting back to hard assets like real estate as a reliable hedge. Real estate is increasingly seen as a sanctuary for capital preservation when the stock market becomes unpredictable. The commercial sector, particularly Grade A office leasing, is also feeling the indirect tremors of these geopolitical shocks. Global MNCs may delay their expansion plans in India due to global uncertainty, potentially leading to a short-term slowdown in leasing. Despite the headwinds, hubs like Bengaluru continue to see strong underlying demand for high-quality Grade A supply. Cities like Bombay are showing resilience, with major financial institutions like SBI proceeding with massive global IT center leases. The shortage of true Grade A commercial space in major hubs continues to keep rental yields stable, despite the global uncertainty. A key question is whether the conflict will discourage overall investment enough to offset the positive effects of recent trade deals with the EU and US. Foreign institutional investors are showing increased caution, leading to capital outflows that the Reserve Bank is working hard to manage. However, domestic institutional investors are expected to provide a crucial pillar of stability for the Indian market during this period. In the residential segment, speculative or off-plan projects may face some pricing pressure if sales activity slows due to cautious sentiment. Both developers and buyers are adopting a wait-and-watch approach, monitoring the conflict's duration and impact on oil. Sustained oil prices will ripple through to daily living costs, groceries, transportation, and travel, affecting overall disposable income. This reduction in disposable income could further temper demand in the affordable and mid-segment housing categories. In contrast, the luxury and high net worth segment remains relatively shielded, driven by long-term wealth preservation strategies. Experienced and liquid investors often view these periods of geopolitical volatility as a unique opportunity to acquire high-value assets. Historically, the Indian real estate market has shown remarkable resilience after such initial geopolitical shocks. The long-term outlook remains positive, anchored by strong domestic demand, urbanization, and increasing transparency. At Acres to Yards, we continuously monitor these dynamic developments to guide your investment journey. Across this 10-minute series, we've analyzed the macro financial shifts and the evolving reality of Indian real estate in 2026. Vigilant monitoring of crude oil prices and global capital flows will be essential for navigating the months ahead. Despite the challenges, Indian real estate remains one of the world's most resilient and attractive destinations for long-term capital. Our mission is to provide you with the premium insights needed to secure your future in India's most resilient markets. Contact Acres to Yards today for a personalized analysis of your real estate portfolio. Secure your future with us. Specializing in the high-growth markets of Punjab, Mohali, and Chandigarh, we are your local experts with a global perspective. Acres to Yards, your bridge to India's most stable and premium real estate opportunities. Subscribe to our channel for ongoing updates on market trends and exclusive investment opportunities. Thank you for watching.